Hi, this is A.K. Asnani from Smart VRC. Dear new investors, warm welcome to this wonderful world of stock investments. Due to COVID, lot of new investors have entered stock market during last 6 months. Being in this market from last more than 3 decades and a strong passion for equity research and equity investing, I feel moral responsibility to guide the new investors. I know you must have made lots of efforts to understand the market and the stocks. Must have visited websites, consulted brokers, worked on media advice, watched YouTube videos, read papers, consulted friends, neighbors, and tapped all other possible sources before stepping into this market. Some must have been doing a homework on annual reports, and others must have worked on filters to shortlist the potential stocks. I am very sure you must have earned decent returns on your investment during this period. And many must be thinking that stock investment is an easy cakewalk. Some may be asking why I stayed away from stocks for so long. There was a broad-based rally in the market since the last week of March 2020. To be precise, 23rd March 2020 formed the recent bottom. And since then, stock market is up by 45% and your stocks also participated and hence you gained. Have your investments gained to the extent of 45%? That was the kind of returns delivered by Nifty and Sensex. You must have earned the kind of returns for which it takes years for the bank fixed deposit to deliver. Right? To be honest, whatever returns you have earned were mostly by chance rather by intelligence. Yes. How can I say this with so much of confidence? Because in the short term, stocks move predominantly on rumors and speculations. There are tens of millions of knowledgeable and experienced investors who daily make hectic efforts to earn returns. Ask yourself what expertise you have to outperform them. Why should market reward you? Moreover, despite so much of knowledge and wisdom, more than 80% investors quit the market, literally forced to quit the market within 5 years after losing substantial capital. I am not discouraging you, dear investor, but only requesting you to be patient. First understand what kind of investors really create wealth from stocks, how they have created enormous money. Were they short-term investors or long-term? Were they using the technical analysis? When I say technical analysis, means the charts and other types of theory, or the fundamental analysis. Fundamental analysis means related to the finance. Without doubt, stock investing is a must to create a fast-growing second source of income, but it is equally filled with challenges. It is not the financial knowledge or IQ alone which counts. It has equally to do with mastering emotions, and that wisdom comes with time. It takes many years to regulate emotions. Often investors lose their capital much before that masterly state arrives. But to gain control on emotions, you must have the insights about the fundamentals, about the parameters, about the management, and that helps you to control, to master your emotions. Be extremely careful. Get associated with experienced, successful, and fiduciary type of advisors. It is really very difficult to find a good advisor than to find a good stock. There is no harm in paying a small fees. Even those who invest in actively managed mutual funds have to pay about 2% every year as expense. And even then, majority of mutual fund schemes are unable to outperform their respective benchmark indices. Be very careful. Be vigilant. It is your hard-earned money. Wish you every success. Happy investing. Now I request Mr. Kishore Purswani sir to start his today's webinar and the very first webinar of this series titled Why and Where to Invest.
Hi everyone, this is Kishore Purswani. Just now, my friend and founder Smart VERC shared with you while welcoming you that how tough it is to invest in a stock market. I, on behalf of Smart VERC, welcome you to this new webinar series which we are primarily organizing for the beginners in the market. During last 6 months, Smart VERC and especially Mr. A.K. Asnani has organized more than 60 webinars for the investors who are deep into the market. As he shared that many new investors have entered the market and they would have definitely earned because the markets have delivered phenomenal returns in the last 6 months, returns to the extent of 40 to 45%. And this would attract many more investors. But is this repeatable? There is no question at all. This performance cannot be repeated. It's sheer by good luck, by chance that the market crashed in March and recovered almost to the previous levels that they have been able to deliver the returns. I have been investing in market since 1985, but let me be very frank with you. Whatever returns I have got in the market, I have earned in the last 6 years or 7 years, right from 2013 onwards. I'll be sharing the success stories with you, the pitfalls, the mistakes I made in the stock market, so that you don't need to reinvent the wheel. How many of us are aware of the basics of investing? In fact, when I started to invest, I was not aware. I clearly remember requesting my mother to spare some funds so that I can invest in shares. Yes, the first share I bought in 1981 was Oswald Agro at a rate of 51. Earned some money there, then started investing. Lost some money in the various crashes because I was not aware where to invest. The markets have given me a great learning, and the very purpose of this webinar is to share with you my learnings so that you can also learn and invest fruitfully if you want in the market. In the first instance or the first webinar of this series, today we will be discussing why and where to invest. Why are you investing? Is it just because you have heard that your parents have invested, or your friends have invested, or your colleagues have invested over the last few years and have earned? Or you have some financial goals which you want to meet. The financial goals may be children's education, house purchase, children's marriage, maybe retirement planning. Maybe you may be planning to retire at an early stage, which most of the youngsters are doing now. They are planning to retire at an age of between 40 to 50 years. And Probably if you don't have any financial goals, like I didn't had any financial goals when I started to invest. I was not even aware of that we should have financial goals. There was no knowledge in those days, no internet, only hearsay. We are lucky today, you are lucky today that you have ample knowledge available on the net, in the books, where you can go, study, and learn. So you are investing for financial goals or you are investing for a parallel income because the income which you are having today is not sufficient. On the other hand, some of you might be having surplus funds every month and you want to invest them somewhere and also at the same time beat inflation. Yes, this is very important. Otherwise, inflation is more or less a termite. It eats away our capital in the long run. We'll see how various investment avenues have delivered the returns over the years. But even before we see that, what are the investment avenues? Where can we invest? Yes, gold is the most preferred investment in Indian families. The PPF, all salaried class employees, besides the CPF or VPF, have an account in a post office bank or a bank and open their PPF accounts. It was definitely a very good investment a few years back, but the returns have dwindled. The interest rates have dwindled. Similarly, fixed deposits. It may be of banks, it may be of post offices, it may be of corporate houses. They delivered handsome returns in the past, 13 to 14%, but now they are down to 6%. And the present indications show that the fixed deposit rates are going to fall further. And probably all of you would be aware that Federal Reserve has shared that till 2023, probably they'll be operating on zero interest deposits. Real estate is another avenue of investment, but then it has its own pitfalls. You require a huge amount of money, and we'll be examining each of these investment avenues in the next slide. And of course, then the stocks. So there can be other avenues also. Some of you might be trading in commodities, some of you might be investing in commodities. But then these are the 5 investment avenues which are generally available, generally sought for. If we have to compare the investment of avenues, what should we see? Or what do we normally see? We normally look at the returns. But it is very important that along with the returns, we should also look at the risks involved. We should also look at the liquidity. It is not always possible that whatever investment we are making for a long term and we may not require it. But the fact remains at any stage, because of certain emergencies, we may require the funds. The investment avenues should be such that they are liquid also. Coming to the first option, gold. It is the most preferred investment. But if you see over the years, yes, if you compare 2019 to 20, you'll get attracted from 35,000 to 56,000. But if you take in long run, gold has not delivered good returns. The returns are very low compared to the other avenues. Of course, there is no risk. Nobody has ever lost in gold. Liquidity is high. If you invest in pure gold, you can go and sell it. But if you invest in ornaments, although the liquidity may be high, but the returns will further come down because there will be deductions on account of various accounts. And if we have to invest in real estate, yes, the returns could be medium. In fact, there was only one indices, if I remember. Somewhere NHB started with an indices in 2007 with covered 26 cities, and the returns in 7-8 years was 8.34 or 35%. Since then, it has not been tracked. The, we say that the risk is low, but if we are aware of the scandal in Noida, what has happened to the investments in Noida, in Gurgaon, why Noida, Gurgaon, even in Bhopal, even in my case, I had invested in a flat in 2010 in a branded investment from a branded house, and probably they have gone bankrupt. Even those 15 lakhs after a lapse of 10 years are not recoverable today. I need not mention the houses, but we are all aware. So the risk in real estate, although we have written is low, but today it has increased to medium levels and the liquidity is very low. There was a time when people were investing in second and third properties. So the liquidity was high. But now, with government norms, government regulations, people are opting out and the liquidity has fallen down considerably. When we come to PPF, the returns are to the extent of 8 to 8.5%. Risk is practically there is no risk. Liquidity is low because for first 5 years you cannot withdraw anything. And the entire withdrawal is only after completion of 15 years. Partial withdrawals are possible, but after completion of 5 years. Fixed deposits, low returns, low risk. We can say high liquidity, but again at a discount. The FD returns or the FD rates which are offered for 5 years, and if you have deposited for 5 years, and if you go and encash your deposit after 1 year or 2 years, there will be severe deductions. Yes, stocks have delivered over the years. You might be seeing that risk is indicated low and that too in red. It is just to attract your attention. We'll be sharing with you in the next few slides why we say the risk is low. And of course, the liquidity is very, very high. Very high, better than any option. You go and sell your stocks today in the market during market hours, and on the third day, money is in your bank. That is the amount of speed which is available today. So let us compare the rate of returns. Gold, the returns have been compared from 1981 to 2020. Gold has delivered 7.9%. FDs have delivered on an average 8.93%. PP have delivered 9.74%, while the BSE Sensex has delivered 13.73%. And the inflation during this period is 6.76%. So if we have to compare the real returns, we should see net of inflation. We'll see in the coming slides how these avenues have performed. Net of inflation and net of probably falling interest rates. So why do we call stocks as the most productive asset? Because all the other assets are dummy, whereas stocks can go on performing. We can compare Stock investment to a jockey and a horse. Here, horse is the company and the jockey is the CEO or the management. It depends on the skills of the top management of the CEO, how far, how fast it can take the horse or the company. And if you are wise enough to choose a company which has a sound management, a good CEO, your stocks are going to deliver over the years. And there are many examples you might be aware of if you are not even aware of the basics of investing, but you would have heard stories, read about these stories, how people have earned over the years. Now, if we compare the rate of returns, FD 6%, some tax on it. Suppose you are in the minimum slab rate of 20%, and the inflation, the net of inflation and net of tax will be only 1.3%. Sensex, if we take the average of the previous years, 13% CAGR, and if we deduct the tax rates and the inflation, the returns will be around 8%. So if we invest in FD, our amount will double. Any guesses? In how many years? Yes. Maybe you not be able to guess, but it is 54 years with present rate of returns. Yes, friends, 54 years with 6% rate of interest and 1.3% real rate of returns. So real rate of returns, the money will double only in 54 years. Whereas if we simply go and invest in a Sensex, our money will double in 9 years. Compare 9 to 54 years. So stocks are no doubt the best investment options available today. These are the known figures and we know all of them. These are the people who have not only created companies but have created wealth by investing in shares. By buying a stock, we are buying part ownership in a business. We become a partner in the business. As the company grows, our wealth also grows. Is stock investment risky? Many of you will say yes, but I say emphatically no. No, if we are investing for a long term. The story will be different if we are thinking of making money in short term. We'll see some slides. Let me be very frank, the risk and volatility are different. Risk is losing our capital. Volatility is a degree of change of stock prices. The more volatile the market is, the more will be the change in the stock prices or the indices. Now just see this index. This is Bombay Sensitive Index. Many of you might be tracking or would have heard the index in January 1990 was 700 plus. And on 25th September, that is the last market day, it was 37,000 plus. 52 times straight rise. But yes, if you see, there have been severe crashes. And the most prominent crash was of 2008 when the market crashed almost 60%. And again in 2020, highest on 12th February, 41,000 plus, and lowest on 23rd March, just 26,000 plus. A crash of almost 38 to 40%. Yes, the markets have bounced back almost to the previous levels just about 6 to 7% to reach the peaks. But what would have happened if we had invested at the peak? And just compare this. If you would have invested in 1st January and waited patiently, it would have delivered a linear returns of more than 52 times or 13%, more than 13% CAGR. And just see this slide. In 1 year, suppose you had invested in market for 1 year, then the investment is definitely risky. If you entered the market in January or February, and your investment would have gone down by almost 40% in March. And if you didn't have the courage to stay in the market, not only courage, but to reshuffle your portfolios, then you would have incurred a huge loss. This is where Mr. Asnani shared with you the need of a strong advisor who will advise you timely when to enter, when to exit, where to enter, where to exit, where to reshuffle. We'll be discussing all these when we discuss in the future webinars. There's a myth that I'm not a chartered accountant or a management graduate or a person who knows accounts in details. So how will I invest in market? No, we don't need to be a CA or a management expert. What we need to know is simple mathematics, simple formulae. Basically as simple as calculating compound interest, calculating CAGRs or compounded annual growth rates. But yes, we have to be rational in actions. And we have to show patience in investment. And very important, we need to have some understanding of the business also, maybe in simple terms. If you feel that on all these 4 points you can score, definitely you can be a very good investor in the market. This is what Peter Lynch, one of the most sought for investment managers, the author, has to say. Everyone has the brain power to follow the stock market. If you have made it through 5th grade, yes, 5th grade maths, you can do it. These are the words of Peter Lynch. I'll conclude for today by saying that succeeding in stocks is simple. We, the investors, make it complex. So what we look at complexity, in real terms, it is not there. We make it more complex. Thank you very much for a patient hearing. And after this, the forum will be open for your question and answers. And since this is my first webinar, I would like to seek your valuable feedback. You may share your suggestions with us on the WhatsApp or through email, and we'll be conducting such series or such webinars probably on every Sunday. Let us see how things unfold. Thank you once again.